Hey there, everyone. Happy Fed Day. Happy Wednesday, May 7th, and welcome to Chart This with Dave Keller. I'm your host, Dave Keller, coming to you from a kind of overcast, but still comfortably high in the low 60s kind of day here in Redmond, Washington. Hope you guys are doing well and enjoying the day's volatility as I am here today as we sort of take a deep breath and digest what we learned today. Fed Day for May of 2025. What did we learn new today? I don't know if a whole lot. The general message that we got, besides no, change to interest rate policy as of this meeting, that means the next possible time when we could see a change in the Fed target rate would be at the June meeting. After that, I mean, the market is basically pricing in a very low probability of a change in rates at that June meeting, which will be June 18th. I think 80% chance that rates remain the same. And that's basically been going up. Not too long ago, it was a sort of a bygone conclusion that would be the first rate cut at the June meeting. Now, basically 80% chance that happened. That does not happen, and basically the most likely scenario is the first rate cut at the July meeting. So timeline continues to be pushed down the road. If I learned anything from listening to Chair Powell answer questions and describe their methodologies and such, it was sort of a wait and see mode. It was a sit on our hands and gather more data type of mode, which is in some ways, I guess, encouraging because it certainly could have been more hawkish or more negative. The downside is it's basically waiting for data. And I don't know about you, but I'm less optimistic that the data on inflation and everything is going to get better, assuming tariffs do take form and do take shape and are implemented in some way beyond what we've seen so far. So again, the market pricing in, I think I would argue market still pricing in perfection in terms of inflation and et cetera, et cetera. We'll see what happens as always. I don't know if we learned a lot newer today. Certainly meant quite a lot of volatility today. And as we look at the market action, getting to our market recap, you'll see what I mean looking at the charts of the S&P. So here's yesterday, which was sort of wait and see mode. We had some earnings and some random news flow, but it was more of a quiet, kind of lighter day until the sell-off at in the last 30 minutes of trading. Today, kind of choppy around, but I mean, look at the range, right? Today's low, not too far from yesterday's low. Today's high, not too far from yesterday's high. So if you were looking for the Fed meeting as a big questions answered kind of day where we get the sense of what's going to happen next, I don't know about you, but I definitely did not get that sort of feeling. If anything, it reminded me excess volatility, excess uncertainty, still very much the story. And the problem is, and I think this is the kicker. I mean, generally, when the markets are more volatile and there's more uncertainty, that's usually not a bullish outcome for stocks. So that is usually the way you describe market conditions at or near kind of a bearish rotation, because the market likes uncertainty, not uncertainty. The market likes low volatility, not high volatility. The market likes being able to value potential earnings growth and not being almost completely unable to triangulate future earnings growth, right? The market likes the Fed saying, we got it, here's how we're lowering rates, and here's why the data supports it, and not, we're not quite sure how this is going to play out, so we're going to wait and see like you all are. So again, I mean, my cynical view of what I'm seeing and hearing is this probably resolves lower. Having said that, as I've mentioned many times, the market does not care a moment what I think. It's going to do what it does. Let's look at how the evidence played out today. What we're going to do is talk about market conditions. We're going to focus a little bit on the Feds. We'll look at interest rates. We'll look at the TLT, which is a bond ETF. We'll look at the chart of the 2-year Treasury yield. This is a trick that Tom Mclellan actually shared with me years ago and has mentioned it randomly, that the 2-year yield is a really good leading indicator for Fed interest rate changes. You'll see what I mean when we get to that chart in a little bit. All right, here's the choppy, sloppy session from, really 1:45 to 2 p.m. on. It was pretty noisy, but in the end, we didn't even break out of yesterday's range. The S&P closes at 56.31. That's up 0.4% from yesterday's close. The NASDAQ composite up 0.3%. Mid caps, small caps up slightly. So the Dow at positive 0.7% is your best performer today. VIX moving slightly lower through the course of the day today. So the VIX actually rotated lower after the Fed announcement and during the Fed meeting through the close. The VIX actually lightened up a little bit. So if you're looking for a positive something at the end of the trading day, I'd stick with that. The VIX finished today around 2350. And that's down 1.2 VIX points from yesterday's close. So, the bull scenario from here, I think, has to involve most likely volatility at least remaining at or below these levels. The VIX starts going higher, and that's really more of a bearish sign than anything, given historical market tendencies. All right, looking at interest rates, the short end of the curve, of course, tends to follow is really based off of Fed policy, so remaining essentially stable. 5-year, 10-year, 30-year points all drifting lower. The TLT, which is a Treasury bond ETF, higher by 0.4%. There's the 10-year Treasury yield. You can see it actually gapped lower after the announcement as bond prices rallied, but through the course of the afternoon going into the close ended up bond yields actually ended up drifting higher generally into the close. So, slightly lower, 10-year point around 428 right now. The dollar index actually slightly higher. This is something to watch. It actually accelerated to the upside between 2 and 4 p.m. Eastern. That's an emerging trend to pay attention to. Dollar generally has been weaker so far in 2025. So any sort of change, any inflection point, I think always really important to hone in on. Commodities not particularly great today. You can see gold rolling over as stocks sort of appreciated, generally finished a little bit stronger after a noisy session today. You can see gold actually doing pretty well until 2 p.m. Eastern. After about 2:15 starts to rotate lower. The GLD down 1.5%, silver down 2.4%, copper prices weaker, crude oil prices weaker. You've got natural gas up, but everything else in the red today looking at commodities. Cryptocurrencies, essentially flat, to be honest with you, right? Bitcoin's basically where it was at the end of yesterday's session. That was after a big rally going into the end of the 24-hour period for Bitcoin. Currently flat around 96,800 and change. Ether prices right around 1,800. You can see the rest of the top 10 coins tracked on stock charts, mostly in the red. All right, looking at the 11 S&P sectors, only 3 of them down today. That's pretty decent. Technology, number 1, up 1%. This is probably one of the more compelling market themes. And when you think about sector leadership and tendencies within the equity space, technology leading the way higher would arguably the most bullish thing that I think you could see, to be honest with you. Stocks like AMD following through after gapping higher on earnings. Stocks like NVDA gaining. Other semiconductor stocks bouncing off of their recent lows. Other big technology names improving. That's all going to be pretty positive. So technology number 1, consumer discretionary, the XLY number 2, up 0.8%. Now that sector has been struggling a bit because Amazon's been unable to get above its 200-day moving average, still hasn't done it. Tesla has been struggling to get above resistance, hasn't quite done that yet either. But overall, the XLY doing okay today. Healthcare number 3, up 0.8%. That's a nice change from what we've seen here over the last week, which is healthcare getting battered pretty bad with some of the big drug companies, especially taking it pretty hard to the downside. Speaking of sectors going down, you have materials down about 0.6%. Not too bad of a day, but that's your worst performer. Communication services, number 2, only down 0.2%. And when you look at the bloodbath that Alphabet experienced today, and I love this, as far as I can tell, it's someone at Apple saying that Alphabet's business model's in trouble. Talk about the joy you have to feel torpedoing a competitor's stock on a day like this. So well done, I guess. But the XLC overall still slightly lower. REITs about flat for the day, as were energy stocks. And energy stocks have been beaten pretty good here recently. The breadth overall was kind of mixed, to be honest with you. Net more positive than negative. But if you look at the New York Stock Exchange, about 60% of the stocks up, 37% down. On the NASDAQ Composite, 51 up, 45% down. The S&P is where it has the most bullish breadth today. With the S&P members, 72% advancing, 27% declining. I mean, it's interesting is if you look at the last couple of weeks, the breadth for the S&P 500 the strongest out of any of these indexes, right? So if you look at the broader New York Stock Exchange, if you look at the S&P large cap, the S&P mid cap, the S&P small cap, the strongest breadth by far has been with the S&P 500 itself. It tells you that large stocks over small stocks still the place that is still the theme that's working here in May 2025. You know what? Basically the difference between the S&P and then the New York Composite Index is basically you obviously have a lot more smaller companies that are incorporated into the New York Stock Exchange Composite Index. And as a result, it's those smaller names that are not doing as well as the larger names. That's why the breadth is skewed to the large side. The cumulative advanced decline line for the S&P has made a new all-time high in the month of May, while all the other advanced decline lines have not yet done so. As an example of that difference in breadth. All right, looking at the Magnificent Seven and Friends, I mentioned technology doing quite well. The technology components, at least some of them within the Magnificent Seven, doing quite well today, particularly NVIDIA and Broadcom, that is. NVIDIA up over 3% today. Broadcom up 2.4%. I think I grabbed the chart of NVIDIA. I don't believe I grabbed the chart of Broadcom. Amazon number 3 up 2%, and that's pretty good because it's been sort of lagging behind, failing to get above its 200-day. Still not quite there, but days like today kind of help. On the downside, Alphabet, as I mentioned, some negative news, really questioning the search model, their basically their main revenue source in the age of AI. It's funny, I'm reading articles about the headlines and the argument against Alphabet because people aren't using Alphabet anymore. I don't know about you and how much your behavior has changed. Mine's changed quite a bit. I probably about half the time use a Google search, which is what I used to use 100% of the time. I mean, literally 100% of the time. The other half of the time, I'm using Perplexity.ai. I'm using ChatGPT. It's like if something that I need is just trying to find a website, I use Alphabet. If I actually need usable information, I use AI because it basically does a better job of synthesizing that information. Now, Google's trying desperately to get their own AI bubbling to the top. So the moment you do a Google search, you're faced with their AI results. But again, I find when I'm going to Google, I'm trying not to use the AI. So I usually just skip right over that and go to the websites because I just want to find a website. So I think that is and again, that's just my experience. But I have a sense that others are in that similar boat. And so, again, I think the way that we think about, I need this piece of information, where do I go? That seems to be changing. That's been changing for a while. And I think what's happening today is maybe a wake up call of sorts with investors recognizing that really can eat into Alphabet's, main revenue source, one of them, certainly. All right, let's continue on looking at the heat map, the market carpet. As a reminder, I can see questions that are coming in on all of these different platforms on Facebook, LinkedIn, YouTube, and X. I appreciate you guys so much tuning in live. Those that are doing so here on Fed Day, and we'll get to the charts of some fixed income related items here in a few moments when we get to the chart review. I can't see questions that come in on any of those platforms, so just put a comment wherever you can on those platforms. I can see them real time. We'll take a question or two at the end of the episode. Anything we don't get to, we've already had some really great questions so far this week. We'll add it to the mailbag. And on Friday, we're planning an all mailbag episode and would love to answer your questions there when I have a little more time and energy to do so. All right, looking at the market carpet. And again, I'm such a fan of these visualizations. Over my career, I've been very thankful at opportunities that have come randomly, whether it was at Bloomberg and doing some early work with digital signage, whether it was at Fidelity and installing big digital interactive spaces within the Fidelity chart room, and then working at stock charts and trying to improve functionality like this market carpet. I've enjoyed it very much, and I've often been drawn to visualizations like this that allow you to go broad and more specific all in one place, right? Allows you to sort of take an overall sense of where things are at, but then you can draw in and get more granular and really understand the specifics. Allows you to go micro to macro, macro to micro, that is. And again, I love that. That I think is one of the great benefits we have analyzing the markets in 2025 that I feel like my predecessors 50 years ago in 1975 would have just loved to be able to see the data in this form. It was all done by hand, so they're unable to do so. Let's take advantage of the great computing power we have available on our laptops and mobile devices and enjoy it. So what are our takeaways looking at this? I mean, a very mixed day, to be honest with you. I'm seeing quite a lot of random red. I'm seeing quite a lot of random green, but the average color kind of nets out to a neutral in my opinion, right? I'm sort of on a yellow light. Seeing some green light, some red light, and then a lot of yellow. I think is where the average kind of comes out. Let's start with the things that are a little concerning. I mean, Alphabet obviously down 7.3% is not good for communication services because it's a big weight. Luckily, Disney was up over 10% today. That sort of helped to alleviate the negative reaction to Alphabet. And Meta and Netflix, the two second and third largest stocks within the XLC, and that's bottom middle on the market carpet. The good news is those, number 2 and 3 were up a decent amount, so that helped to temper the negative I feel like impact of Alphabet being down. But if you hold Alphabet, this certainly hurts. And again, if you own Alphabet, you're assuming that they're going to navigate that whole people not using Google the same way that they used to sort of thing. Again, I don't think that's a bad idea to assume that a big company like Alphabet, a conglomerate with an endless supply of capital to throw at any issue they run into, if anyone's going to figure out how to save that sort of revenue source, I bet they're probably on that. Having said that, it is a very real issue. So Alphabet down in the upper left, right? You have Uber down on earnings, CrowdStrike, Arista, 3 names in bright red in the upper left corner. But having said that, those were the negative outliers, right? And Uber's an interesting one because it is literally testing a new all-time high. I feel like Uber's not the only stock rallying up to the previous peak and then failing to get above there, right? We don't have a lot of stocks on the new 52-week highs list right about now. And that's one of those things I would argue if conditions are bullish and if this is a recovery and a new bull market phase, I feel like generally charts like Uber probably break out because people are thrilled to own great companies and have a lot of optimism about what's going to happen next. I feel like when Uber's and others that we've highlighted recently on the show fail to get above previous resistance, I think that's a problem. CrowdStrike very close to making it to a new high, testing the February peak, failing to do so today, down about 5%. So, taking a step back, those are things that kind of concern me. I mean, flipping to things that are more encouraging, NVIDIA starting to not look like a disaster anymore. I mean, it's not the best chart I could identify for you, but it's not the worst one. And NVIDIA really, for one point, making such a clear pattern of lower highs and lower lows. That's changing, right? We've now made a higher low and now a higher high. I did grab that chart. We'll talk about that in a little more detail about what the chart's telling us about the conditions. But I think NVIDIA, a very encouraging chart. Broadcom pushing above 200 this week, an encouraging chart as well. Disney, we actually grabbed that chart. We'll talk about that today, pushing above $100 a share. Big round numbers always jump out off the page at me, which is interesting. Within healthcare, I mean, these charts are not particularly good over the long term, right? Something like Charles River's up 19% today, but this is after, making a new 52-week low in early April after a 12-month deterioration phase. So I don't know if it's, the best chart I could identify yet. But again, not looking as bad as it had before. So healthcare generally not a great place. I mean, out of all the 11 sectors, healthcare is probably, besides healthcare and energy, I don't know which one would be my pick for least attractive from a technical perspective, but you could definitely, those two are in the bottom 3, I would say, at this particular moment. Other than that, I would say the heat map is more opportunistic. There are random things that looked good. There are random things that did not. And again, I love starting here, moving the mouse, kind of grabbing, a chart. If you see something that just catches your eye, write down the ticker or double click on it and go into the chart. That's kind of how I use this visualization. I'd encourage you to kind of explore things that way as well. All right, we're going to go into the chart review portion of the show and look through some of the charts that I found interesting with a focus on the S&P and on some Fed-related charts. Before we get there, as a reminder, Seeking Alpha has been a great partner to Market Misbehavior over time. Is doing a spring sale right now. If you go to marketmisbehavior.com/seeking alpha, you can find more information. Basically, the deal they're offering is $30 off Seeking Alpha Premium, which is their premium package. And they're also throwing in their next Alpha Pick for free, which is their quantitative research team led by Stephen Kress, who I've interviewed on my podcast, hand selects one of the stocks that ranks well in their quantitative model. They dig into it a little deeper and present it as a good actionable opportunity, as an alpha pick. All the information you need, you can scan the QR code or go to marketmisbehavior.com/seeking alpha. Doesn't cost you anything more. It actually gives you a little better deal and helps me to make market misbehavior awesome. So please check it out if you're so moved to do so. All right, let's go to the chart review and let's look at some of the charts and how they've played out today. And again, I mean, one of the things that stands out, I mean, Fed day for me, I mean, particularly this one, right? You're not really expecting any change in interest rate policy, which we didn't. You're not really anticipating a big, moment of clarity. At least I wasn't, about what was going to head next, because with how much Powell and others have talked about being data dependent, the data is very mixed right now. And there's not such an obvious action that the Fed needs to take, or else the market would be pricing in a bigger change. And right now it's pricing in no change today, which was true, and no change at the June meeting as well, which means we've got another 2 months before the first time when the Fed could actually lower rates, which gives us a lot of runway between now and then for all sorts of craziness to happen. So the next thing I'm doing is just taking a step back to see how different markets are reacting. If there's anything, on the bullish side, I would say the fact that the S&P just didn't go down is good. I would say the fact that, gold's starting to drift lower. I mean, arguably that's probably a good sign for stocks if you see hard assets rotate lower, because certainly there's been flows over there, and arguably some speculative flows, like myself enjoying the uptrend and betting on an uptrend going to continue. At some point that probably changes. But what I'm struck about looking at the chart of the S&P is we literally had a nothing burger from yesterday's day to today's day. Yesterday was the wait and see, let's see what happens today. Today we had the meal and we didn't go anywhere, right? The high was not too far from yesterday's high. The low was not too far from yesterday's low. We did close a bit higher, but really wasn't a big directional movement kind of day, right? A lot of Fed days, you see a big optimistic surge going into the close, or a big sell the news, get out of the way kind of move. We got neither of those. And so I think, again, the problem we have is we're left with more indecision, more uncertainty, and probably more instability and more volatility, which are all things that, again, my assumption is that resolves downward in some way. Now, having said that, the way that I think about the chart of the S&P right about now, we're on a yellow light. Think of it as a stoplight. And again, what I would generally say is below 5,500 is a red light. We break below 5,500. I personally would be very skeptical and very hesitant to be adding on risk. At some point, it probably looks like a really good buying opportunity. And latest episode of my Market Misbehavior podcast with Megan Horniman. Megan's a portfolio manager at what's the name of her firm? I'm so sorry, Megan. Verdance Capital Advisors in Baltimore. I think that's correct. Megan was awesome. I mean, the first time I'd met her, I'd followed her work and enjoyed it, and had a chance to ask her questions. We talked about recessionary pressures, Fed policy in 2025, inflationary pressures, valuations, earnings season, leadership rotation, growth versus value. I kind of hit her with anything I could to triangulate how we make sense of it. And I thought some of her sort of comments were really, really interesting. And I hope you can enjoy that. But basically, what we both agreed on is, her comment was, I'm pretty sure that was the low. I'm a little less, 100% confident that was the low. But I would say if and when the S&P gets back down to this level, I think you have to be thinking on the long term and thinking of that as a fantastic buying opportunity. And what Megan and I talked about is every major correction has ended up providing an exceptionally good opportunity to buy great companies at a steep discount. So great to not miss that opportunity. So for me, S&P below 5,500 tells me to hold off, wait for further deterioration, wait for a better opportunity to layer in and add risk. Between 5,500 and 5,800, I think we're in a yellow light. I think you wait and see. And again, we're literally right in the middle of that range. That tells me there's mixed messages. There are things that could be construed as positive, and certainly things that could be construed as negative. And it's hard to tell which one of those takes control. And over the last week, the S&P is saying it doesn't know either. S&P above 5,800, we clear the 200-day moving average, we clear the March swing high. I can't be bearish anymore. I mean, and I can't be that skeptical. You have to just believe that we're going higher. And again, I don't think that's an unreasonable ask to be patient and wait for that validation that the bull side is going to be the case. The last 5 Mays, as I think I showed on the show yesterday, last 5 years, May has been a positive month. 4 out of the last 5 years, June has been a positive month, and 5 out of the last 5 years, July has been a positive month. So sell in May and go away has actually been more of a midsummer or a couple months after May kind of selling opportunity. So we'll see, right? But I think in terms of the trend, I think we're in a yellow light kind of phase. Now, a lot of the short-term breadth indicators, as we've discussed, have gotten quite bullish. The Mlullen Oscillator is one we agreed to watch very closely because it's a short-term measure of breadth. Interview I did with Tom McClellan months ago really talked about the origin story of the Mlullen Oscillator. If you missed that one, check it out on my YouTube channel. It was really cool hearing about his parents, Sherman and Marion McClellan, how they designed the indicator, why it came about, and how it was popularized. Some of that I knew, and a lot of it I didn't. It was a lot of fun to learn about it from Tom. But as a short-term measure of breadth, for now, still okay, right? And we're above the zero line. You look for that to break below the zero line, which often indicates at least some short-term distribution, that the short-term breadth had been positive and is now starting to weaken. For now, it's holding above that zero level. That's not quite updated for today's close just yet, but I don't think it would be breaking below given the breadth conditions that we saw. Another thing we can look at, stocks above their key moving averages, as we've talked about. Most members of the S&P are above their 20-day moving average. It's about a coin flip as to whether they're above their 50-day, but now most are. But most stocks are not above their 200-day moving average. And I think the encouraging sign is we've seen stocks regain some of those short-term moving averages. The question now is whether they regain the long-term ones, what we call the long-term market barometer, the 200-day moving average. More stocks get above the 200-day. And again, think about the names that have rallied to their 200-day and failed. Amazon, Apple, Alphabet, Tesla. These are names that have been unable to get above their 200 days. So for every Meta that's broken above there, or Netflix that's been in a primary uptrend, you got a lot more that are not above their 200-day moving average just yet. And I think that would be one of the great confirmational signals you could see from this particular chart. Not there yet. All right, let's talk a little bit about the Fed. And again, the quick version of what we learned today is that the markets have been choppy and sideways, but it really is a period of indecision. What the S&P basically did was sell off when tariffs were announced, regain all of that deterioration as tariffs were delayed. And now we're in this not quite sure what tariffs are going to look like, unclear what the eventual impact is going to be. What concerns me is a lot of the people I talk to cite evidence of things that are not going well, that are just not reflected in the data just yet. And I think that was an important point from comments I heard from Chair Powell today was, that might be true. And I'm paraphrasing. Someone asked something about consumers or supply chain or something, and it was, well, that might be true, but it's not reflected in the data yet. And that, I think, is one of the big issues you have with economic data. It's always delayed, right? You don't really get the reports about what the economy did last month until next month, right? And so there's this lag between when things start to get ugly and when the data actually reflects the fact that things had gotten ugly, which is why the stock market is usually a really good indicator, because people will hear rumblings, they will hear whispers about things, they will validate it independently, and they start selling early because they're afraid that the market's going to go down. When the market actually does recognize it on the weaker data, the market's already down and is sold off as a result. And I think that's the risk right about here, is there's this gap between conditions are getting rougher for consumers and it's going to affect behavior and things are going to get more expensive. And we just haven't seen that reflected yet in any hard data. It's all soft data that we're hearing. With that in mind, if you look at the chart of the 10-year Treasury yield, and this is on stock charts, $TNX, and most charting platforms have some version of the 10-year yield you hopefully can get to. I mean, it's literally sideways, dead sideways from late February to early May, right? So for the last 10 weeks, it's gone nowhere, right? It's fluctuated from around 3.9% in early April up to around 4.6%, a week later. But at the end of the day, that is netted out to being exactly in the middle of that range, which is where we're at right now, right around or just below 4.3%. The 200-day moving average is almost dead flat. I don't have the RSI pictured here, but if I did, I'm pretty sure it would be kind of right around 50. And that's sort of what this is doing. The fixed income markets are sort of in wait and see mode. Arguably, the 2-year Treasury yield is one of the things you may want to look at. We have that in a chart or two that I'll show you. But for now, I would say the 10-year yield remarkably, choppy and noisy, but sideways. Directionally, we're coming out of this period where there are these clear uptrend phases, clear downtrend phases as bond markets were going up and going down, and you could really track the period or the phase that yields were in by looking at the highs and the lows. Now you kind of have this weird diamond-shaped pattern, which is essentially a consolidation pattern, telling you we're sideways. So I think again, it's TBD. It's to be determined, right? And maybe the way you think of it is this is an outlier because of the April tariff sell-off. This is an outlier because of the sell-off in bonds soon after. Maybe we've settled back into a tighter range from around 4.1 to 4.4%. We wait to see which way rates break out of that range. But the yield curve from the 3-month to the 10-year point is essentially dead flat. The trend in the 10-year, I would argue, is sideways. We wait and see. Here's the chart of the TLT, which is a bond ETF. I technically color-coded this momentum bearish because it's below 60 on rallies, but it really is, more neutral than anything. If you look at the last 10 weeks, right, we've sort of, after here in late February, we got above an RSI of 60. From there, it's mostly been between 40 and 60, which is basically neutral momentum. So, interest rates sideways, the bond price action, if you look at the TLT, essentially sideways. We're pretty much exactly where we were in mid-February, which is exactly where we were last November. And we're right about at that point. And so again, I think the markets in general are waiting for more data and waiting for the next headline to determine whether we should be getting optimistic or not. And I think the sell-off post-tariff, the rally, afterwards now digested, and now it's what's next. And I'm not seeing a big directional move since then. All right. This was the chart that I mentioned Tom Mlullen sharing a long time ago with me. He had mentioned this before and has shared it on social media. You might have seen it there if you follow him on X, for example. But his comment was predicting the Fed's actions very easy. All you need to do is look at the 2-year Treasury yield. So the yield on the 2-year note is $UST2Y on stock charts. And I'm also looking at the Fed target rate, which on stock charts is $, Fed rate, which you can see in the upper left here. So I'm basically showing the two of these together just so I can, and on the same scale. And then the bottom half in purple is the S&P 500, just for comparison. This is a long-term chart, a weekly chart going back to basically the early 2000s. What you want to look at is the relationship between the black data series, which is the 2-year Treasury yield, and the red data series, which is the Fed target rate. If you look, the 2-year Treasury yield really started to rally from mid-2003 into mid-2004 before the target rate was eventually raised. 2-year yield sort of stalled out and came down here as the target rate held steady. 2-year yield started to rotate lower, and then we see the target rate, the Fed target rate, continue lower as well. Here we have that weird sort of zero interest rate policy period from 2009 post-financial crisis. But eventually, look how the 2-year Treasury yield starts creeping up in 2014, 2015, and then eventually late 2015, the Fed starts raising rates. 2-year yield topped out in the fourth quarter of 2018, while the target rate was actually still going up. We flattened rates for about 6 months before the target rate went down. You saw that same leading action in late 2021, rates down at zero post-COVID as a way of trying to address and not tank the economy during a pandemic. But the 2-year yield starts creeping higher, and then the Fed starts raising rates. So arguably, the 2-year Treasury yield stabilized while rates were still going up, and now rates flattened. Then we have those rate cuts from the second half of last year. Now we're sort of sideways. So the real question you should be asking is, does the 2-year Treasury yield break down here? For now, certainly the trend in the 2-year Treasury yield has been lower. While the target rate has stalled out, the 2-year Treasury yield still going down. That breaks below 3.5%. I think you have to consider that that's still in a downtrend. Maybe that coincides with the Fed sort of resuming their rates, and again, that relationship makes sense because the 2-year yield is more driven by market forces and expectations about what the Fed may do, and it's often a leading indicator, as you can see from the chart, of what the Fed is actually going to do. So that might be an important chart to watch to really confirm the fact that the Fed starts lowering rates at the July meeting. See what the 2-year yield does between now and early July. All right, let's talk about some individual stocks, and we'll take a question or two, and we'll be done. Looking at the MAGS ETF right up to the 200-day moving average, and I'm thinking this is one of those charts we just want to follow. The Magnificent Seven are split right now, right? You've got Netflix and you've got Meta pushing above their 200-day. Netflix by far the best chart, but you have a number of the Mag 7 stocks underwhelmingly weak, or certainly at the lower end, or much weaker and below their 200-day moving average. If the MAGS ETF gets above their 200-day, I personally would say high likelihood that the S&P and the NASDAQ break out of their own and have sustainable gains beyond what we've seen so far, and that probably means strength into the summer, maybe a summer peak that we have to deal with. If, however, the MAGS ETF stalls out and is unable to get above the 200-day, there's just not enough market cap in other areas of the market, even doing quite well, to create a sustained rally in the S&P and the NASDAQ. So I think this is maybe the chart to watch to see if we break out on stronger momentum. It hasn't just happened yet. Two of the Magnificent Seven look remarkably weak this week. Apple down another 1%, although it was down to around 193 earlier today. Did close back above 196. That's right at the 61.8% retracement of the April 24 low to the December 24 high. This rally to a descending 50-day moving average. The RSI didn't get much above 50. So I would say overall, this is still a distribution phase. The short-term rally is certainly impressive. If you draw a trend line off of these April lows, it's now broken. The gap lower last week and then continuing lower this week. Apple's in a period of distribution. Alphabet getting some skeptical news, or I guess some negative news flow today about their ability to monetize or continue monetizing search when search is kind of an old technology that's not getting less obsolete week over week. And so the chart of Alphabet rotating to the downside, and this is after a week of kind of stalling out around 165, now resolving to the downside. I would say that is a period of distribution continuing below a downward sloping 200-day. AMD, I actually saw in the chat yesterday. I didn't go through the question, but I will tell you, it's sort of right at that point, right? It undeniable. We've seen a strong move off of the early April low. Is this undeniably a bullish chart on the medium-term time frame? I can't say that yet. I would tell you what I'm watching is a trend line on all these stocks having nice rallies. Draw trend lines off of the April lows and see if and when that breaks. At some point, that trend line probably breaks. That's probably the sign that we're in a new bear phase. For now, I'm just seeing us as with declining moving averages. We're breaking above the 50-day. The last time that happened, that was pretty much it for the rally. So we'll see if we can have sustained gains above there. But I still think there's more to prove on a chart like that before it gets super bullish. Here's NVIDIA. I was going to say, I thought I drew that on the chart of AMD, but I was thinking of the chart of NVIDIA here. Draw the April 7th low, the April 21st low. You can see that lines up currently around 108, we'll call it, with today's session. I like the fact that NVIDIA is above its 50-day. That's not a bad thing. Getting above the March swing highs, getting above the 200-day, that's what completes the bullish rotation. RSI above 60, that would be bullish as well. Short-term rally has been good. I would watch the trend line. As long as we hold that trend line, do you follow the trend higher? I get the argument. I would love to see a break above moving average resistance to complete that. Disney, and this is one of the few individual names that I own in a long-term portfolio. I've got Disney and Berkshire Hathaway and a bunch of other sort of long-term. I like the story. I like the theme, long-term generator of wealth type of things. And Disney is one of them. Thrilled to see the stock gap higher. I was actually on CNBC Arabia earlier today. So shout out if anyone that follows that broadcast is tuning in here today. It was challenging because we're doing it with an interpreter and doing it over Zoom, which is always kind of an interesting challenge. But so I really didn't get a sense of how the show is going from the viewer's angle, which I always like to do. But it was a good but brief conversation. But news just came that Abu Dhabi in the United Arab Emirates is going to be getting a new Disney ballpark theme park. Which is part of their growth plans. But a nice gap higher today for Disney. Gapping above the 200-day, does it hold? And if so, I think that's a fantastic breakout. The 200-day moving average right at today's low, right at $100 a share. That's kind of the level. So if you're really excited today and you take a position, I would use the low of today, the upper end of that price gap, as your natural stop. MasterCard, good chart, right? And this is what I talk about on some of these names that have had good V bottoms, getting above the March high, breaking above previous resistance. That's the thing that really validates that buyers are taking control and pushing us to new heights. I like that breakout on MasterCard. The breakout on Visa, not as awesome, but still pretty good. I think the payment processors, the credit card companies, setting up pretty nicely here, threatening new all-time highs. So there is cause for optimism, I guess, if you look at the right thing. All right, let's take a question or two, and then we will wrap up for the day. I have to go get a haircut, so we got to have our priorities in line here. Let's see. Dodo, thanks for watching on YouTube. Dave, would love if at some point you could talk about methods to monitor investment flows between U.S. and non-U.S. investments. Hard to assess optimal allocation ongoing. I really appreciate that question. It's a really good question. I mean, the challenge you've had in 2025 has been there's been a big gap between U.S. and non-U.S. markets. Right, here's the chart of EFA, which is a it's the EFA ETF. So that's global developed markets. So developed Europe like Germany and Switzerland, developed Asia like Japan, all in one kind of ETF. And it's been remarkably strong, way stronger than the U.S. markets, up a decent amount year to date. Even with the sell-off that we saw in April, it's regained all of that and more and made a new all-time high here in the last week. The problem is there's this huge performance gap between the developed European markets and U.S. markets right about now. And the question is, does that continue? Obviously, tariffs are a part of this, right? And I think there's a macro story here that could still be in the early innings, which is, are there? And again, I'm not a my area of expertise is technical and behavioral finance. If you do this long enough, all you do with people at water cooler discussions or talk about other things. And a lot of the interviews I've done get into a lot of other topics. I mean, I think the risk right now is there's a lot of arrangements between China and someone else that we have nothing to do with. Arguably, the U.S. has been sort of a central trading partner, kind of defining global trade. If that's not the case anymore, and tariffs sort of jeopardize that, is that great for European markets and maybe re-exert their own independence from the U.S.? Maybe that's a very good thing. And the markets are telling you that's a pretty encouraging sign right about now. The weaker dollar has been a big part of that too. So I would say one of the reasons, if not, the main reason why non-U.S. markets have been so strong on a relative basis is because the dollar has been so weak. The dollar tipped higher today. I would keep an eye on that dollar chart. If anything else, I would say at this point, the strength that you've seen year to date in non-U.S. stocks is a friendly reminder from the market gods that just being completely naked non-U.S. markets is usually not a great thing. Betting the house on non-U.S. markets, usually not a great thing for U.S. investors either, because there are a lot of themes and leadership and growth that are U.S. stories that you want to have exposure to. But having some percent of your portfolio in non-U.S. markets is very much the case. I had 0 international stocks, or very, very few in 2024. I have more now because you've seen that rotation away from U.S. dominance to other areas of the market. I think that could be an important theme through the remainder of this year. And I would encourage you to take a look at the dollar index, because I think that's a big part of the story. And sorry if I'm mumbling. I had to get up at 5 a.m. to do that interview, so I'm a little bit on the struggle bus. I'm gonna go nap as soon as we're done here, probably post haircut. But let's do one more question on Microsoft. The JLD. Thanks for watching on YouTube. Hi, Dave. Can you look at Microsoft and talk about the probability of Microsoft filling the gap to the downside from earnings? So so what's happening with the chart of Microsoft, I think, is really interesting right about now, right? If you look at what's happened, I love to highlight stocks that have what I call a gap and run, right? You gap higher and then you just run, right? Because what happened is from one night, we close at 395. The next morning, we open above 430. We close around 425. So from this close to this close, it's up $30 a share. That's what, 6, 7, 8% is somewhere in that range. It's a pretty big, markup from one day to the next. So the question from that moment on is, are investors willing to pay that premium for the potential gains of Microsoft down the road? Because we've now revalued Microsoft, at a higher valuation because we are expecting future earnings growth. And the question is, at what point are investors not thrilled to take that bet? And I would say the most bullish thing that happens in this environment is a gap higher and then a move higher, what I call a gap and run, because a gap higher followed by additional buying tells you that investors are not looking as much about the marked up price. They're just thrilled about the long-term potential. That's usually how long-term gains can be compounded. The worst case scenario is you gap higher, you close at the lows of the day, and then you just immediately go into the gap range, which tells you everyone's thrilled to cash out and the price goes lower. Microsoft has done neither of those things. It gapped higher, and from there, nothing. We've been dead sideways. So basically, the optimistic buying happened, but there's not a bunch of additional buyers coming in thrilled to pay even more and more from Microsoft. It's sort of stalled out and we're waiting. So I would say the most concerning thing that I would see on the chart of Microsoft, which is why I have an alert set at this price level, would be Microsoft below 425. Because while that might not be the end of the world, and there still could be some opportunities like at the 200-day to find support, it basically tells me that that bullish earnings story is not really the main thing that investors are trading on anymore. And I have to look for other information. But I think that gap range, super valuable to look at right about now. And I appreciate you asking about Microsoft. From a macro perspective, stocks like that breaking out and not breaking higher beyond that, kind of an issue. Folks, I'm going to thank you so much for watching the show. Thanks for tuning in live, those of you that are doing so. And on Facebook, LinkedIn, YouTube, and X. I appreciate all the questions. I didn't get to all of them, and I will put the remaining questions into our mailbag. We're planning an all mailbag episode on Friday. Between now and tomorrow's episode after the close, be well, enjoy your evening, and remember, it's always a good time to own good charts. Have a good night, folks.